Welcome back to Online Trading Summit. Adam Grimes is our next presenter and he will be sharing with us how to be a winner in trading through trading edge, psychology and discipline. Adam has over 2 decades of experience as a trader and system developer. He is also the author of a very popular trading book, The Art and Science of Technical Analysis, Market Structure, Price Action, and Trading Strategies. In this video, Adam talked about what Trading Edge is about and how to go about finding it. He also shared about why trading psychology and discipline is the key to implementing a trading plan consistently. Can't wait to hear what Adam's got to say, so let's get started right now. Hi, Adam.
Hi.
Welcome to this online trading summit. Thanks for coming on board to be one of the speakers for this summit. We are really happy and honored to have you on board. And you are a very famous figure, frankly, to many of the traders in Asia Pacific as well. Especially for that book that you wrote on technical analysis. I've actually read that and it was really helpful. So. Well, before we go into today's topic that you'll be sharing with the summit participants, I was wondering if you could just take a minute or two to share with us how you actually got started in trading and what was the journey like for you through these years. So would you like to share with us a bit more about your background?
Well, I told a lot of this, I think, in other places, other formats, but I really got started like most retail traders. I probably had no idea what I was doing. This was back in the mid-90s, and when the scams still came through the mail rather than email. And I got something in my mailbox that was basically about how to start with a few $1,000s and corner the cattle market. And I had no experience with financial markets, certainly no education with financial markets, but I thought, this kind of sounds like fun. Let's try it. And so I bought the course, went through the training, opened a small account, and the account, of course, disappeared right away. I had absolutely no comprehension of risk or leverage or just how the whole mathematics of trading worked. But something about the experience was it's hard to put into words, but something about the experience really grabbed me. And I said, this is something that I think I can figure this out, but it's going to be a lot harder than I thought. And so that kind of began a process that still continues to today, I think, to really figure out how markets work. And, my formal training, I was a musician, but I also had, I think I was a little bit of an unusual musician because I had a very quantitative background as a kid, at least informally. I was very interested in science. When I went to college, it was a little bit of a debate between whether I would go for music or whether I would study a hard science. So I decided to study music. And the outcome of that, of course, was that I had no rigorous quantitative thinking in college, but I had some idea how to think scientifically, and I knew the skills. At least I knew some of the skills that I did not have that I would need to have. So I taught myself things like statistics and, just basically how to look at information, how to figure out probability. I'd played just a little bit of poker, so I had some idea about how, for instance, a strong hand doesn't always win, et cetera, et cetera. I learned, I had some help from some mentors who were very important to me, and then I went through just kind of a matter of trading at the right place at the right time. Still in the early 90s, and I had this was all dial-up. I had 2 dial-up modems and one phone that I was calling trading floors. And so I made a little bit of money day trading, and then this kind of went through a cycle, day trading currency futures actually. This kind of went through a cycle where over the next decade or so, I explored other markets. And each time I went into a new market, and the most traumatic was the S&P futures. When I went into the S&P futures, and this was after the dot-com crash, I had a really tough time making money at first. For even having the experience of making money trading, I still struggled for a couple years to learn a new market. and I'm kind of glossing over a lot of things, but I got a formal education. Eventually I got an MBA, came to New York, spent a few years working on the New York Mercantile Exchange, traded for a big prop firm, launched an institutional advisory service most of 10 years ago now. So I've been writing daily market analysis. And I think one of the things that's a little bit unusual about my background is that I've traded every liquid market that you can easily trade. I haven't traded bonds, but it's not a very liquid market. You know, it's a specialist market, but stocks, options, futures, currencies, and everything from very short-term trading. I've spent years trading a 1-minute chart, and I've also built long-term portfolios. So I've kind of been around the block a few times. And as you said, you've read my work. I blog extensively, and I think another thing is a little bit unusual about me, and maybe it's my music background, but I really like to teach. And so for me, writing blogs, doing the kind of work I'm doing in the Facebook group right now, writing the books, that's a lot of work, but it's pleasant work. And it's work that I find, and you probably find this yourself, when you articulate your ideas very clearly, when you teach, it makes yourself better. You know, it's very hard to write down and tell people exactly what they should do, and then to go do something stupid yourself. So if you're kind of teaching people best practices, that's naturally going to filter into your trading. So I find that there really is a virtuous circle where over the years, my work has helped a lot of people. And, you know, almost every day I get something from somebody saying your work made a difference for me, and I'd much rather hear that than to hear, oh, you know, your work is so great, or I really liked your book, knowing that I've been able to, in some cases, take somebody who struggled for 10 years and then they find my work, and it's kind of the last piece of the puzzle that really takes them to success. That's enormously gratifying for me, but also you know, it's definitely helped my own trading and made me better at what I do too. So that's kind of the thumbnail sketch of where I've been.
Yes, exactly. In fact, I totally agree with you. Personally, I enjoy the challenge of making complicated principles and topics and putting them into easy to understand analogy, and the joy you get by helping people understand how something works and how they can actually apply that. So when I actually invited you to become one of the speakers for this summit, you pretty quickly decided that you wanted to talk about something that the hardest thing about trading. So that was the topic that you wanted to talk about.
Yeah.
So why do you actually decided that this is a topic you want to emphasize on for this particular summit?
Well, I think as you correctly identified, there's a little bit of a conflict. If you focus too much on why it's difficult, you risk focusing on negativity. And I think I've been guilty, you know, like if you go, one of the interesting things about blogging is that it's kind of like this archaeological record of your thought. And, you know, I think if you go back in previous years, there probably were times when I was a little bit too negative. And I think that it's important because there are a lot of people that tell you, just learn this pattern and you can make money. Just learn this super secret combination of moving averages, or learn to use Fibonacci numbers and you can make money. And what we find is that it doesn't really work like that. And we know it doesn't work like that. And I don't think any of us, frankly, fully understand why it does not work like that, because the essence of what you do as a trader is really quite simple. You know, for instance, let's say I'm trading patterns off a 1-hour currency chart, I'm looking for pretty simple patterns. I'm getting into a trade with a few seconds analysis at, you know, not even a minute. There's no way that I spend a minute figuring out if it's a good pattern. And I know immediately where my risk is. I know where my exit is. This all seems to be very simple. I could write it down on a piece of paper that's not as big as my phone. But if I gave that to somebody else, you would be completely unable to replicate that. So it's a little bit of a mystery. Why is that? And that question of why trading, which appears to be so simple. You know, it's not like, you know, I'm also a musician. It's not like playing the piano. If you came to me and said, I wanted to learn to play classical piano, well, you know, then we are embarking on a highly specific, highly skilled discipline, and it's probably going to take you 5 or 6 years before you're even moderately competent. We all understand that. We understand the reasons for that. We know the very clear small building blocks that we need. In trading, it's not that clear. And in trading education, frankly, there are a lot of scams out there. I have, and we can talk about it a little bit more later, but I have a massive free trading course, which you've probably seen. It's 30 hours of video. Over the years, I've done it twice, so this is a completely new version that's out now. And the reason that was put out was to counteract a lot of what I saw as abuses in the trading education industry. Literally people paying $10,000, $15,000 for courses that would be nothing more than you take 2 books off my shelf and you pay $50 to $150 for the books, and you have everything that's in the course, and the instructor does not trade. And I found this out. I knew this. I knew the inside of some of these trading operations when I created the course. I don't know what, 7 or 8 years ago, but I saw it even more clearly since then, because a lot of these, and I'm not going to name names, but a lot of the big online trading courses have tried to buy my course and or hire me because they don't like the competition. They don't like something free out there. And so I've had a chance to talk with a lot of the instructors who are former insurance salesmen, former car salesmen, former brokers, people who worked in back offices. Like there's a guy right now who is talking about how you should never learn trading from somebody who is not registered with a regulatory agency. But a lot of people who are registered with regulatory agencies, the majority of those people had nothing to do with deciding when to put on risk and take off risk. They're working back office, they're working front office, customer contact, they're asset gatherers. And that's an important part of the industry. I'm not slamming that part of the industry, but I'm saying, the person you want to learn trading from is the person who has cried and bled and who has had the experience of putting on trades and taking trades off. And those firms just don't have that. Those aren't the people teaching you. So it's kind of been a journey for me to understand, how do we teach most effectively? What do we need to teach? Why is the, we say trading is a skill. What are the skills of trading? Why are they so difficult to transmit? And that's really the way I think of it. It really is almost a transmission. We use that one place, at least in English, that we use that word is in some of the old martial arts thinking, like a master would transmit to the student. The student doesn't learn. The student, the student does learn, but it's really a transmission of, in that case, the tradition. And in this case, there is a little bit of that transmission of skills that go beyond what can be quantified. So what I want to do here, and I think my presentation is pretty short here in 20 minutes, there's probably not going to be a lot in there. There aren't going to be any sexy patterns. I'm not going to show you, when this line curves and you buy, you're always going to make money. There's not going to be any of that. And you probably have heard most of what I'm going to say, maybe even all of what I'm going to say in that presentation, but I think it's very, very important. It's deceptively simple, and these are the things in my 20-odd years in trading, both in my own work and in teaching quite a few traders. These are the things that I think really start to point us toward how do we find our success and why success is so elusive for so many traders.
Great. So I'm all psyched up right now to hear about all the hardest thing about trading, just to remind myself all over again and internalize. Right. And also for you to share with us some tips on how to overcome all these hardest things. Maybe that's something that I think would be really helpful for the summit participants. So I'm going to hand over the stage over to you right now. So just go ahead and share whatever you would like to share with the summit participants. Over to you, Adam.
Thank you. Great. Okay, so we've titled this Trading, Winning the War Through Statistics, Psychology, and Risk Management. Let me click on the slide. Okay, so quick outline of what we're going to do today. There are good reasons why trading is hard. Even though it turns out to be harder than most of us expect, there are good reasons for that. But we still make it harder than it has to be. And we do that through some fundamental misunderstandings. We don't understand what psychology looks like. And we also don't understand what success looks like. And that's where I'm really going to wrap up the presentation today. So first of all, let's think about what is a financial market? You know, it's very easy today. We go to any number of websites and we pull up charts. You can pull up quotes for markets. It's hard to go through a day listening to news on the television without hearing somebody talk about some market price. But what does that mean? Where do prices come from? And this is kind of an idea that I don't think people think about enough. You know, you think about humanity and you think about the things we do. We build big buildings, we settle in cities, we write literature, we write love songs, we sing, we create religion. We do all of these things, but that we understand as, let's say, fundamental expressions of the human spirit. But one of the other things we do is we barter for things, we trade for things, and surely this has been going on since the beginning of recorded history, probably before. So I think this is such a basic element of human civilization that, you know, a lot of times we trade, you think you're just pushing a button and people wonder what value is there really in this, but I think you're participating in something that stretches back in an unbroken line to those cave paintings that people were making tens, hundreds of thousands of years ago. Also do realize that in financial markets, everyone is trying to get an advantage. There is nobody that goes into the market, any rational person, sane person, that says, I want to lose a lot of money. Now, there may be trades we do where we want to lose a lot of money, and that's kind of a mind shift for people too. What do I mean by that? Well, if you're hedging, people don't think about that. You know, people just say, okay, you know, I'm hedging. But if you are hedging, what a hedge is a trade on which you hope to lose. So there are times when maybe we make a trade and we hope to lose, but really, people are trying overall to get an advantage. So markets are extremely competitive. And how do we win this game? In this very competitive environment, which, by the way, attracts some of the smartest, most well-capitalized, it's not very good English, they are the best capitalized people in the world, smartest people in the world come to financial markets to figure out how to make money. How can we win in that competitive environment? And I think one of the secrets and one of the core misunderstandings here is that you really have to have some reason that you should be able to win. We call this an edge. There's always going to be people that are more naturally equipped to succeed than we are. And if there aren't individuals, then there are firms that will hire them. You know, like every now and then somebody says to me, okay, I'm going to be successful trading because I'm very driven and very focused. And my answer to that is, well, that may be true, but this firm can hire 20 of you. So that's not really an ongoing advantage. So what you need if you're going to profit in the long run is a trading edge. And again, this is a topic, you know, I think one of the really nice things that's happened over the last decade is the trading discussion by and large has honed in on the things that are important. And you're hearing a lot of people talk about trading edge now. In my trading course, we spend a lot of time at the beginning, like before we even look at patterns, talking about an edge. And it's simply a higher probability of something happening than something else. And one of the easy ways to think about this is directional. If you have a pattern that says this market is 55% likely to go up versus, you know, it probably won't be 45% because there's also the other, because there's also a no direction. And that, by the way, is a pretty good edge. You know, like when I started trading, one of the misconceptions I had was that there were these statistical home runs, that people talk about patterns that are always right, or patterns, even patterns that are 70 or 80% right, if you're looking at an equidistant move. You know, of course, if we adjust the goalposts, then you'll naturally shift the probabilities. But that kind of drives us to understanding probabilities. So direction is one, but you also can have volatility. You can have an edge that says, I don't know where this thing is likely to go, but it's likely to bounce around a lot more. It's likely to be a lot more or a lot less volatile over some time frame. You also can have a non-directional edge that deals with the magnitude of a move. So I don't know which way this thing is likely to move, but I know if it does, it's likely to move a lot. That would be another example of an edge. So you know, maybe I'm belaboring the point, but I don't want you to just get stuck in the idea that saying an edge is going to tell me if the market's going to go up and down. At best, it's going to give you a probabilistic tilt, but there are also other edges. I would also suggest that we probably should be able to define an edge clearly. Now, I have to use the word probably here because there may very well be people, and we have to respect this, who have some skill that we can't quantify. You know, maybe there are people who, like I knew a big spread trader who made consistent money over a long period of time, but he really could not explain what he was doing at all. He just understood these relationships in a way that he could not articulate. Now, he spent decades trading these markets, so he kind of figured it out. But I think, especially for developing traders, you really want to be able to define your edge clearly. And if you can't do that, you probably don't have a good enough handle on it. And another thing is that an edge should be repeatable. You know, there certainly are non-repeatable edges. An example of an illegal edge would be you have a friend who's an insider at a company who calls you and says, hey, this is going to happen. Now you have a almost more or less risk-free but one-time thing. And when they catch you, they're going to put you in jail. So it's probably not worth it anyway. But what we're really looking for is something that we can do hundreds, thousands, tens of thousands of times. So if it's a very special situation, it might not be something you can really build a career on. I'm not going to read this whole slide, but just to point out that there are many, many different ways and places that people find edges. And these, you know, everything from valuation to patterns, different time frames, different relationships between markets. People might understand, you know, how with a commodity, how it's grown, how it's sold, how it's stored, how it's processed. So there are a lot of different ways to find an edge, but the key thing is that because these markets are so competitive, whatever edge there is, it's very small. And we do need to remember there are people, and not stupid people, you know, like there are people who say there's no edge possible in financial markets. And for the developing trader, it's very tempting to say, well, those people don't have any idea what they're talking about. Be careful, because those people are people who have spent a lifetime researching the data. And, you know, very, very well educated academics and researchers in many cases will come to the conclusion that markets are essentially random and efficient. So we need to respect that. Now, I happen to disagree with that, and, you know, I can show you many reasons why I disagree with that, but it's certainly a sobering reminder that it's so hard to find an edge, that there are very intelligent people who, with working with teams of people doing nothing but analyzing data, can come to the conclusion that it's not really possible to find an edge in the market. So don't dismiss that just by saying, oh, you know, they're academics, they don't know what they're talking about. At the very least, market data has a lot of noise. I would say a lot of randomness, and this is also one of the, I think of randomness as the enemy in many ways, because it hides the truth of our trading results. It makes our outcomes tied only with the most tenuous connection to our actions. So it's not so easy to get feedback. And the tools to counteract randomness are statistical analysis. This is actually a very good point. You know, just thinking, what we're doing here is thinking generally about why trading is so hard. This is, you know, going back to if I was going to teach you to be a musician, it would be very easy to show you the right things to do with your body to produce the right sound on the instrument, and then you can do it over and over, and I can evaluate it first as your teacher, and eventually you can evaluate, am I getting the result I want? And it's really, you know, it's really, you do the right thing, you're going to get the right result in a one-to-one relationship. And this allows you to do these basic building blocks over and over and make very small corrections. And this is true in a lot of sports, it's true in a lot of disciplines, but it's not true in trading. Any idiot can go into any market and get lucky. I knew a kid personally who paid for his college with crazy buying crazy out of the money options, and it was Google actually, yeah, back in the day, and he then thought that he was a genius trader. But now you have to think about it from his perspective. He took a few $1,000s and ran it into a few $100,000 in the course of a few months. So he looked like a genius, and he now had this incredible arrogance that eventually the outcome of this story was he continued to bleed money until his father cut his trading off. And he always thought, you know, oh, I was going to make, you know, and I don't know what's happened since then. He's probably opened trading accounts and lost money. So you can have good results by doing bad things. And of course, you also can be on the other side. Many developing traders, you develop a system, you find an edge, and you go into the market, and you have an immediate losing trade. Or maybe you have two, or maybe you do 10 trades, and 6 of them are losers. And you're doing exactly the right thing, but it's just truly the luck of the draw. This also means, by the way, that people don't understand the reason for their success. You know, if we analyze quantitatively, a lot of the things that people think have an edge, it's difficult to test. You know, we can't say, if you think scientifically, you can't disprove something. So the absence of a test that shows an edge is not proof that there's no edge. But I think many of the tools that people lean on so heavily, like Fibonacci ratios, you know, I've researched a lot of these kind of mystical approaches, and they're quite difficult to quantify, but you start to look at the data a lot of different ways, and the relationships don't jump out. So it's a little bit difficult to think maybe there's the edge that people think. But there are people who swear by these techniques, and I would be willing to believe that some subset of those people are lying. They're selling something. But there's also probably some subset that does make money, but you know, maybe they make money for some other reason, but they don't understand. So this makes it impossible to teach. Impossible for those people. If you don't understand why you're able to do something, then you're not going to be able to transmit it. And we see this in other disciplines too, but I think it is quite a huge problem in trading. And what we really need is consistency. You know, if you're going to build any kind of career in trading, whether it's part-time or full-time, you're going to be able to depend on pulling any consistent, I guess we should put air quotes around consistent, because markets are so random. Your results are not going to be a straight line. It's not going to be like, you know, I used to have this fantasy that I would sit down in front of the computer, I would trade an hour a day, and it'd be like an ATM. I would just take money out of the computer. And over a larger stretch of time, you have a very high probability of making a profit, yes, but there can always be surprises, and there can always be, you always will have drawdowns, you will have losing periods, and so your consistency is limited. But really the problem is, you know, I've set up, I think, a pretty scary look at markets here. You know, there's such a tiny edge, markets are so random, so many bad things can happen. The paradox is that in this very competitive and random environment, we need consistent results. How do we get that consistency? Well, first of all, you have to have an edge, and then the only way to move toward that consistency is to act with consistency. And this is why traders are always talking about discipline. It's not a mistake. Discipline is one of the most important things, but there's a fundamental misunderstanding about that too. And you also just have to realize that your consistency is only possible within a certain limit. You're always going to have those drawdowns. So kind of a quick mid-presentation review here. Markets are very competitive. There are edges in markets, but they're very small, very thin edges. And if we want consistent results from markets, we need two things: a trading edge and the ability to apply that with consistency. Now, that's intellectual. You know that now. And most of you probably knew that before. Most of you listening to this who are struggling as traders probably just listened to my 10, 15 minutes here, and you're like, okay, yeah, I sort of knew that. But it's really not enough, because it's not enough to take people to success. Why? Well, most people discover when they get in markets, it's overwhelmingly emotional. And you know, this was certainly my experience when I started trading. I thought, I'm a pretty relaxed person. As a performing musician, I could get on stage in front of hundreds of people and I had no anxiety. In fact, I would have to create, you perform a little bit better with a little bit of anxiety, and I would have to create that anxiety for myself backstage. I'd have to imagine, you know, okay, well, what if this, and this went wrong? Because I just did not have any performance anxiety. And I was very surprised when I put on a trade that I had a really incredible and physical emotional reaction. You know, my blood pressure went up, I was breathing, I was nauseous. And I thought, at first I didn't really know what was going on, and then I realized that this is a strong physical response to anxiety that I'd never really had in any other arena with life. It's also not rare to see people just doing stupid things. Like here, as I was doing this presentation last night, I got this email, and I get emails like this all the time, and you can read it, but this person's saying, you know, he has a great strategy for trading. He's been trading for many, many years, but he puts on open positions, and when he has open positions, he gets very anxious, and whether he's winning or losing, he finds he gets out too soon. And I bet most of us can relate to that. And if you can't relate to it now, you probably can relate to it at some point in your trading career. And the point here is that this is normal. This is natural. You know, people think, what's wrong with me? And I've had so many people ask that, you know, what is wrong with me? Am I hopeless? Am I stupid? No, you're not. You're not hopeless. You're not stupid. You are normal. And the reason is that, going back to our idea about markets being competitive, it's actually worse than that. Markets are warfare. Markets are war. Good idea to, everybody talks about the efficient markets hypothesis, which we won't talk about, but Google the adaptive markets hypothesis. And this is an idea that Andrew Lowe put forth that basically says you can look at markets as an ecosystem where you have predators and prey. And if you think about what happens in terms of evolution, you have a predator that's really good at eating the prey animal, and then the prey animal evolves. It develops better camouflage. It develops poison, and then the predator evolves. And so you kind of have this ongoing arms race, and maybe eventually one of them gets intelligent and crawls out of the pond. You know, who knows? But this is what's going on in the market all the time. The fact that you can fund a currency account with a few dollars and push a button and make a trade in no way equips you to deal with this environment that you find yourself dropped into. Another very interesting thing, and this might be new to some people, there's this idea called theory of mind, and that's not on the slide here, but you can Google that. I would suggest reading this paper, Exploring the Nature of Trader Intuition. So theory of mind is the natural human ability to infer intent from a situation. So good examples of theory of mind in normal life, you walk up to a dog on the street. You have some idea, is this a dog I can pet? Is this a dog that is feeling threatened, that is likely to bite me? Most of us have a pretty clear read of that. You walk into a room, you have some idea how the room feels about you. This is what theory of mind is. Well, so in this paper, what they did was they created financial price series, some of which were random, some of which had insiders pushing the market around, driving the market. And they showed these moving price series to mostly, I think, to people who had no trading experience. They just grabbed college students and said, hey, we'll give you 20 bucks if you'll do our psychology experiment. And what they found is that even completely inexperienced traders very quickly could tell that the markets where there were insiders operating. And so this points to some, and then the other interesting point of the paper was that they were able to see through doing some brain imaging that the same brain structures that were connected with theory of mind were connected with this processing. So when you walk into a room and you have a bad feeling like, oh, I shouldn't be here, that very natural human intuition is also operating, whether you want it to be or not, is operating when you see financial prices move. So all of this is, people are wondering, why is this so hard? Why am I feeling all of these crazy emotions? And the long and short of it, so to speak, is that the market is not just some series of numbers. It's an environment that has evolved to hurt you. It's an environment that has evolved to make you do the wrong thing at the wrong time. You buy something, it goes down, you get angry, you buy more, it goes down more, you get really mad, you sell it, it turns around and goes up, and you punch your monitor. And what has just happened to you is not just some random thing, and it's not because you're stupid, it's because the market actually encodes all of this emotion, all of these intents from all of these other traders, and that's the environment that we fight in. Now, if you know this, this is where things start to get really interesting, because a lot of the shame and self-blame that traders feel for years and the hopelessness you see is misplaced. And you see that it's not quite so hopeless. It's not hopeless to be normal. What we have to do is to understand this and then think about ways and strategies for overcoming it. And this is where trading psychology really starts to play a role. You know, I've been critical of trading psychology in a lot of venues in a lot of ways, but trading psychology is really, so you have that objective edge, you have a good system, but you still can't do it. Now we're in the realm of trading psychology. And it is a mistake to think that I'm going to work on my psychology first, because I will tell you, for instance, I hear the most amazing things from struggling traders. You know, like one of the things that I hear over and over is, I'm trying to increase my size. I'm a losing trader. They'll put that right up front, and then they'll say, I'm trying to learn to trade bigger. Well, why are you doing that? So you can learn to lose more faster, right? It doesn't really make sense. And I think it's just as big of a mistake to say, I don't really have a system. I want to work on my trading psychology. Trading psychology is just the tool that lets you go into this twisted market environment and understand what's happening and stick to your plan with discipline. And, you know, there's that word, like everybody says, and I would love to give presentations on discipline, because I think in many ways it's almost the most important topic, but the problem is that discipline is an outcome. I could give you a very motivational speech for 3 hours and we talk about trading discipline. I can tell you all the stories I know about traders, some of whom committed suicide by having actually killed themselves because of poor trading discipline. You know, this is serious stuff. I could impress on you that discipline is the ultimate line between your success and failure. But then you'll go back to the market and you'll just do the same stupid things you've always been doing. Why? Because what both of us failed to understand is that discipline is an outcome. It's a result of you having your edge, having your trading plan, and then following the plan. And that's what discipline really is. It's how well you follow the trading plan. But the trading plan doesn't make sense. You know, like you could have a trading plan that says, I'm going to buy the euro against the US dollar every day at 10:05 a.m. It's probably a stupid trading plan. It's a trading plan, but it's a stupid one. So if your trading plan doesn't have an edge, there's no point to have a trading plan. So you got to get that. You got to have your edge. You got to have your trading plan. But then we focus on how well you execute the plan, and that's where the discipline comes in. But a lot of people just focus on the discipline. And by the way, I've seen traders who very consistently, without an edge, with perfect discipline, have destroyed trading accounts. So all of this stuff matters. Another presentation that nobody can give is, what is the most important thing in trading? And, you know, sometimes people ask me to do that. And the problem is that everything matters. If you're missing any one of these pieces, and somebody explained it to me, I hate, you know, those social science equations where they say like success plus time plus whatever equals this. Well, it's not really an equation, right? It's more of an idea. It's not mathematical. But somebody said, you know, if you were going to create a trading equation, they multiply. They don't add. So if one of those things is zero, if you are a perfectly disciplined, good risk management, well capitalized, blah 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 blah, but you don't have one single piece of the puzzle, the whole equation multiplies to zero. And I thought, okay, you know, that actually kind of makes sense. So understanding why each of these pieces is important, how they fit together, that takes you eventually to being able to execute it. So quick review here. You got to have an edge. You need to verify that edge until you're confident. We didn't really talk about that. We can talk about that for days or weeks. Then you need to create a trading plan that says exactly what you will and will not do in the market. Then you simply execute and follow the plan. And at this point, this is where you deal with psychology, You figure out how to course correct a little bit. By the way, losing, if you want to lose, how do we lose? It's very easy. You do anything else. That slide that I just showed you, you ignore any of those steps, or perhaps even more dangerous, right? You make mistakes at any of the steps. You can genuinely believe you're doing the right thing. You can genuinely believe you have an edge, but if you don't, that's a very good recipe for losing. And I say that a little bit humorously, because the point is not to make anybody a loser, but to understand how and why traders lose. So then obviously we can turn it upside down. And do realize one of the things that was a little bit frustrating for me is that beginning traders and experienced traders have different things they need to work on. And the really frustrating thing is that as an experienced trader, you will sometimes return to those beginning trader mistakes. So like the same dumb things that you did as a beginner, you will do as an experienced trader occasionally. Hopefully you won't do them very often. If you're a discretionary trader, then whenever you have any outside life stress, like an illness or you're vulnerable to some of those beginner mistakes again. But as an experienced trader, what you usually end up doing is find completely new mistakes and completely new ways to challenge yourself. And it's a little bit of an ongoing thing, and I know all of this kind of seems to work against consistency, but consistency is possible if you understand all of the pieces that go into it. So the answer to how do we win the trading war here is you have to have a system with positive expectancy. You need to verify that. You need to crystallize it into a written trading plan. Again, a lot of these topics I could talk about for hours. You gotta have a trading plan. If you're struggling, and you don't have a clear written trading plan, then get a written trading plan, and at least struggle with a trading plan, because that's something concrete you can fix. Once you have that trading plan, you focus on flawless execution. That's where the discipline comes in, and you work on managing the emotions, and that's where psychology comes in. Let me tell you where to find a little bit more about me, and then we can chat a little bit here. As I said, I do have a really comprehensive free trading course. Thousands of traders, more than 10,000 traders have taken this over the years it's been available. It is in its second incarnation. I completely redid it about a year ago. You can find it at marketlifetrading.com. You have to register, but it's completely free. For directional technical trading, this is pretty much a complete education. You can learn more, of course, and you certainly should learn from other people who give you a different perspective on things, but I worked very hard to put everything you need to know. And I have piles, metaphorical piles of emails from people telling me what a difference this has made in their trading. And, everything from very small traders in Eastern Europe and Singapore to traders who spent years on trading floors in New York and Chicago and have been struggling to find their edge once they got off the floor, have done tons of coaching and courses, and nothing really worked, and then they found my free trading course. And of course everybody says, why is this free? Well, I told you earlier why it's free. If I was going to charge for it, it'd probably be a $10,000 course. So, it is what it is. I also have my blog, adamhgrimes.com. It's a little bit of a meandering perspective on my understanding of markets and risk. I've written a couple books, which you're welcome to check out. Also, I do have enough stuff out there that, like, if you're wondering about my research on, say, Fibonacci ratios, which is not favorable to Fibonacci ratios, I'll tell you, you can Google my name plus the concept. And if it's out there, Google will be pretty effective in finding it. I do try to be pretty responsive to email, but I am absolutely buried in email. I guarantee you, in the time we've been speaking here, I've gotten more than 10 emails, and that will continue throughout the day. So I will do my best to get back to you, but my time is somewhat limited. So that's the end of the presentation. I will stop sharing the screen here, and then we can chat.
All right.
Okay,
Thank you so much, Adam. It has been a really helpful session that you have shared. In fact, I really like the part where you share about that equation thing where you have A times B times C, and if you have
Right.
any that is 0, then the outcome is still a 0. So I think that is something that a lot of people doesn't realize how
Right.
important to have everything aligned, at least in a positive kind of outcome, in order to not be end up as a trader who's losing money. So
Right.
during your presentation, I realized that we touched a lot about the edge itself. In fact,
Right.
I think that's really important. Putting aside trading psychology, trading plan, if your strategy doesn't have an edge, it doesn't matter anything else whether it has or not.
Right.
And if you have an edge, maybe even if you don't have a trading plan, or you might not have a very strong psychology, it is still possible to like at least break even or very
Right.
minor profits. But without an edge, there's nothing to talk about because you will have negative expectancy. So
Correct.
with regards to this topic on edge itself, from your experience, I mean, if a fairly new and inexperienced trader comes to you and asks you, Adam, what would be a viable way for me to go around finding an edge that will be suitable for myself, that I will be able to use with discipline? How would you advise someone on that?
Well, so kind of the format that I built into the trading course is to teach that person patterns, because it really comes down to pattern recognition, which can then be done on a quantitative basis. You know, pattern recognition does not mean that we look at the chart and see the dragon pattern eating its tail. You know, everybody thinks the charts are highly subjective like that. But if we understand how markets move in this alternation of relatively clean moves within markets going sideways, and we think about the kinds of structures that might occur within that, I think for a beginning trader, two core concepts to investigate would be, first of all, just the idea of pullbacks, the idea of a market making a trending move and then making some kind of consolidation. And of course, there are a lot of different ways to quantify that and to explain that. But that would be one key idea. The other one would be the idea of mean reversion. What happens when the rubber band gets stretched, whether it's making a large single day move or making an excursion from some average price. I think those ideas as kind of core concepts are probably good places to start thinking about an edge.
I see. So does that mean that some kind of edge are actually pretty timeless, that regardless how things change, those edge, based on some of those principles, some of the edge will always be there?
Well, that's been my experience. You know, I think that one of the things that's a little bit weird about my work is that I've done research into a lot of these very old time series. We have, and data collection is a problem today. It certainly was a problem back then, but we have commodity prices from the Middle Ages. We have barley and other commodities from Europe in the 13 and 1400s. We even have some of those Phoenician clay tablets are price records, merchants made price records. Back then, that what they did was something that's actually a little bit like a point and figure chart. You know, the merchant would not record the price every day, but when a price made a big change, the date and the price would be recorded. So, you know, already they were filtering out the noise. So the availability of data and the kind of analysis we can do on data is a little bit limited. You know, I'm not telling you that you could have gone to Babylon and sat down by the river and traded dates with pullback patterns, but based on what I see in the data, I think you probably could. Based on what I see in the data, I think there is a very high probability you could have traded commodities in 1400s in Europe with pullback patterns. I know that you could have traded stocks in the 1800s with pullback patterns. I know you could have used basic elements of seeing when the rubber band got stretched with different ways. So there are elements of price behavior that are timeless. And, you know, I think everybody is very focused, and now I've been doing this long enough that I've seen the discussion over so many years. You know, like everybody now is very focused about AI taking away all of the edges. Well, we were having this discussion in the 90s with the neural nets. You know, it's not news. Everybody is concerned about the high frequency trading today. Well, back then we were concerned about the floor. So it's kind of a different, it really is a thing that the more the market changes, the more things stay the same in some ways. There are some edges that come and go. You know, arbitrage should be an obvious example. There are in currencies, there are interest rate relationships, trades that you have to think about from a macro perspective that may change and evolve. But the core of a solid technical approach, I do believe, if you're trading these relatively simple patterns, probably is more or less timeless.
And would you think that edge, it's timeless? Is it because due to human nature that it doesn't change?
Well, now, yeah, now, I try to be very careful about what I know with any degree of certainty and what's utter speculation. And so this is complete speculation, but I suspect that it has something to do with how humans process risk, how human psychology and risk intersect, how markets evolve. So yeah, I think it probably is. One of my new thoughts is that just a few days ago is that this idea of financial markets really is, like I said in the presentation, a fundamental expression of the human spirit. It's one of the basic things that the human animal does. And so I guess it's not surprising that whether we're standing under camel skins in the hot sun somewhere and bartering over price of some spice, or we're looking at the relationship of Kansas City and Chicago wheat on a computer screen, that we're still basically the same humans that are making the same mistakes, that are feeling the same emotions, and that have the same cognitive biases. Because it's the same thing. You go back thousands of years, you step out from under that camel skin, you look up at the sky, you're going to see faces in the clouds. You're going to process those swirls in a piece of wood into patterns. You're going to do the same thing. If I look out this window today, I'm going to see, well, it's very cloudy, but we still see the same patterns. We still have the same pattern recognition foibles or mistakes that make us vulnerable to the same kind of mistakes. So yeah, I suspect that's it. I suspect it's something to do with our cognitive machinery and the way it works with risk. I don't really know that.
I see. And I saw from your profile that you have been a system developer as well, right? And you also wrote a book on technical analysis, which is really visual. So what's your take on being a visual trader versus being an algorithmic and system trader itself? Is there any kind of conflicts? And actually, what would be your preferred mode of trading from that perspective?
I think there's more synergies than conflicts, probably. I think that I remember when I put out my first book that there were some people who basically thought they were too smart for charts. Like I would talk to some professional investors and they'd be like, oh, your book was really heavy on charts. Well, a chart is a very useful heuristic. It's a very useful way. I can look at a chart and I can see things about the time series that your risk management system cannot see. I have a sense of whether the trading is continuous or discontinuous. I know how volatility evolves. So you can get all of these quantitative things from a rather casual inspection of a chart. But visual traders tend to be kind of sloppy, frankly, and going through the discipline of quantifying your idea into a precise rule set that can be executed systematically, algorithmically, even just the discipline of dealing with programming, I think that's a useful, there's a whole debate. Can you really develop coding skill very easily? But, until you've spent hours finding a misplaced comma or finding that your calculation was completely off because of a misplaced negative sign somewhere, when you see that degree of precision, I think the visual trader can take something away from that. I think the visual trader also, my experience is that as a visual trader, you can outperform a lot of the things that you quantify systematically, but there certainly are some advantages to systematic trading. And I would also argue, maybe the final word is that systematic trading is not as purely rigorously quantitative as people think. You know, you're still making decisions. You're making decisions, if nothing else, when do you turn the box off? When is it outside of its parameters? What did you test to put into the system? You know, that's still a decision. You still made some decisions. Even these, you know, like there are genetic algorithms where you basically just give them data and they train themselves. They figure things out. Well, as far as I know, those aren't terribly successful, but generally speaking, the human is still kind of shaping there's still some discretionary input even in very systematic trading. And a lot of people want to, you know, one of the things that I hear is, I'm not disciplined, so I want to be a systematic trader. Okay, this is exactly the same thing. You have this big hole in your front yard, and this big deep hole, what are you going to do about it? Are you going to fill it in? Are you going to make sure that it doesn't collapse more? Are you going to get the dirt shipped in and then put grass on it so it looks nice? Or are you just going to build a fence around this hole and you still have the big hole in your front yard? And the systematic trader who wants to be systematic because he's not disciplined, you're still going to lose as a systematic trader, because it's completely possible to override your system in all kinds of harmful ways. So in my mind, you know, we think of these as very different worlds, as very different personalities, and, you know, like every now and then somebody who doesn't know my background will hear me talk and say, oh, but you know, you don't understand the art of it. You don't understand what it's like to be a creative person. Well, I'm a classically trained composer. You know, yes, I think I do. And you know, I certainly understand pattern recognition. There are things to be gained from all aspects of this. And I think one of the challenges, you may very well decide you want to be a purely discretionary trader. You may very well decide you want to be a purely systematic trader. But I think the more you know about different ways that people trade and the more experience you have, the better off you are.
I see. And so suppose that I have a strategy. I think there's an edge. I might have already done some back testing on it. So if I've come to that stage already, and the next stage obviously is I need to think about how to build a trading plan around that edge, around that strategy. So would you be able to like share from your personal experience and opinion, how would you go about implementing a trading plan? So is there a step-by-step process, and how do you actually go about doing, actually based on any kind of strategy that you could potentially be using?
This is also a major focus of the trading course. There's several modules in there that deal with the trading plan and that have examples of the trading plan. But you know, I mean, like it doesn't have to be complicated. In fact, it shouldn't be complicated, because what it really needs to be is a document where you can ask yourself after every trade, did I follow this trade? And did I follow my plan? And if your trading plan is the equivalent of a 14-page legal contract with points and subpoints and subpoints and subpoints, it's too hard to evaluate. So, you know, ultimately, it's something relatively simple, which, yes, is a problem if the pattern is discretionary. You know, then we have other issues with defining the pattern, or if you're trading multiple patterns, all of these things are things to consider. But really, at its core, the idea is, okay, I have this pattern, I've tested it, I think there's an edge, here's what I think the pattern is, and then you can go through a process of, the goal is to not lose a lot of money, right? You know, it's probably going to cost you some money, but you don't want to lose a lot. So I would suggest, like, you have the trading plan done, and then you forward test it. You trade it in a simulator, and you develop a set of maybe 20 to 50 trades, and depending on how you trade, maybe this takes you several months. And you might think, oh, I don't have time to do this. Well, you don't have time not to do it. You know, it's like you can skip some of these steps, but you're probably going to pay for it somewhere down the road. So you first of all, forward test it, and then you trade with very, very, very small size. And it's a problem in some markets, you know, like trading commodity futures. There's a limit to how small you can trade. If you're trading commodity futures on daily charts, you probably need to risk thousands of dollars per trade, realistically. With currencies, that's not true. With stocks, that's not true. So that might be a reason why the, you know, I think about it as granularity of risk. You basically want to be able, at this early stage, you want to be able to lose for weeks and weeks and weeks and months and months and months. You're not going to feel good about it. You know, you're probably going to be frustrated and discouraged, but I don't want you to be hurt financially. If you've gone through this process where, let's say you find out your edge doesn't work, and you've also ripped through your living expenses for the next 3 years, now you have a very serious problem and you're not going to be able to trade. But if you can say, well, all that's happened is, and it's significant, but I've wasted time and I've lost just a little bit of money. You know, I mean, to put numbers on it, you know, I don't know, people in different parts of the world, let's say you lose the equivalent of maybe 2 nice dinners. Like, you know, you went out to 2 nice dinners. That's a reasonable amount of money. You know, you're frustrated, it's significant, but it's not the end of the world. Well, now you can adjust the plan and then go through this process again. But if you get through that test and you see your results are good, you've made a tiny amount of money. How much money have you made? Well, maybe the amount of money that'll get you a nice meal or two. You know, you're not going and buying a car or an airplane. Then what you do is you start to increase the risk a little bit. And again, here's where the granularity of the risk matters. And what you're probably going, and if those results look good, you increase the risk more and you increase the risk more until you're trading meaningful size. And what you're probably going to find is that somewhere along that line, like you had your back test, you have your forward test, you have your trading on very small size, and then you have your trading with significant size. Somewhere in there, it's going to break down. You're going to find that, you know, there's kind of a natural decay. First of all, your forward test is probably not going to look as good as your back test. If it does, congratulations. But, you know, so what we look in the forward test is, do you still have an edge? Why is it not as good? If you don't have an edge, then maybe you made mistakes in the back test. And so there's learning opportunities at every stage. The forward test looks good. Then you start trading on very small size and you lose consistently. What's up with that? Your simulator trading looked good. Your real money trading, even trading a tiny, tiny, tiny micro lot, you're losing money. What's wrong? Oh, well, your simulator was assuming you would always be filled on the bid. Your simulator was not accounting for the spread. You know, so how is the real world different? And then you can adjust, and then you discover maybe I didn't have an edge. Maybe you need to go back here. So it's not, you know, necessarily one thing. But then, you know, so your forward test looks good. You're trading small size, it looks good, and then you increase the size and you get stupid, which is, you know, then that's just the caveman brain making us make those mistakes. So now you deal with psychology and discipline, and you know, so there are different stages where maybe it makes sense to work with a team. Maybe you need to work with other traders. That's something that's probably trading such an isolated thing. This idea of working with a team is not really appreciated enough. It can be the difference between success and failure. Maybe there's a point where you need to work with a coach. Maybe you have a mentor, whether that's a formal or informal relationship. Maybe you just go up on a mountain and sit and think about what you're doing. You know, so there are all kinds of different ways to deal with this, but it's really understanding where your focus needs to be at each stage. And if you kind of look at the decay of performance, you know, your actual trading is not going to look like your back test, but if you have a strong edge here, you should have an edge here. And how do we maintain that edge, and where do the links break down? That's kind of how I would think about it. That's kind of a long answer to your question, but I think that's really the big picture.
Yes, yes. I think that's really very helpful. Something that I didn't think about before, about focusing on the different stages of where you are. Having a back test first, forward test, risk small before you risk big. And I think that a lot of people try to skip a few of these different stages and end up they wonder why wasn't they able to make something successful out of it. So because they have actually jumped all the steps. So I think that's a very, really important part. And yes, and finally, before we end off today's discussion and interview and a presentation, is there any last words that you have for the summit participants, especially those aspiring traders who's just starting out? any kind of inspirational words you have for them to help them to just stay in the trench and just continue to work on it?
Well, you know, my work and my focus is kind of like anti-sensational. You know, everybody's always showing you the pictures of themselves in pools with models and the helicopter waiting, and you know, and I work again because I think most people who present trading like that is kind of a scam. So the bad thing about my approach is that I think it can be a little bit negative. It can be a little bit dour, maybe, to use an old English word. And that's really unjustified because this is a way you can change your life. You know, you can. This is a skill. There's nothing magical about it. Chances are, if you have any kind of formal training in any discipline, you've probably learned and done something that's more difficult than trading intellectually. This is not that hard to learn. The financial rewards can literally exceed your wildest dreams, but you just need to be prepared for it to be difficult. And you need to be prepared for the reasons you struggle, the reasons you will fail initially. And that's why we focused on this here, are not the reasons most people think. It's not because you can't do it. It's not because insiders are taking your money. You know, there's all this reason, there are all these reasons that people come up with. It's because the challenges of trading are really not what we expect. And if you start to understand the reality, and I guess I would encourage you to be, there was a time when my trading, when I focused on GAN ratios, when I focused on all of this mystical stuff, and it's very hard to leave some of your preconceptions behind. It's very hard to face the sobering reality of what works and what doesn't. It's very, you also come to a point where trading is a little bit boring, and that's good, by the way. But it's difficult to get to a point where you realize that trading is not going to be the exciting, glamorous event that I thought it would be. That it's more of a grind. And if you can embrace that, if you can work through that, it absolutely is worth it. The impact on your life financially and the ability to quite literally change your life and to change your world, it's there. But it's not easy to get, but it's certainly possible. It's certainly worth it.
Perfect. I think that's a very realism about the trading itself that I think it is important for those trading mentors and coaches to be realistic about it with new traders, because if they come in with the kind of thought that, with the greed, with the thought that it's going to be easy, and end up they will discover, why am I not being successful? So I think that's a very humbling kind of realization. I hope that your presentation has provided to the participants so that they can start trading again on the right footing, on the right foundation, in order to become a successful and profitable trader. Thank you so much again, Adam, for your time today. And I hope to have a chance to have a chat interview with you again in the future. And meanwhile, I wish you the very best in whatever endeavors that you are focusing on at this point in time right now. And hope you have a chance to chat again. All right?
All the same to you. Thank you very much.
Thank you so much, Adam.